All right, guys, Broadview Table Talks, thanks for tuning in. We are about to head into the long weekend. So if you're listening to this long weekend, happy Victoria Day and enjoy.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends and talk about the real estate and the ever-changing market in Toronto.
So we are somewhere in the middle of May. April's numbers we're going to be looking at today. But I find that we are in a spring market that hasn't really sprung.
Yeah. Compared to the other spring markets that I attended, I feel like there's just a lot of properties that are just staying on the markets and nothing has been really going anywhere.
Yeah, for sure. And that's attributed to the lack of sales that are happening, right? Like there's a lot of inventory that's happening right now, a lot of new inventory that's coming on the market, which is going to make things even worse. I find that it's all because of interest rates at the end of the day. Mm-hmm. So there's going to be a rate cut announcement a rate not cut now, it's about a rate announcement on June 5th. So everyone's like crossing their fingers for that. There's June, there's July, and there's September. So at some point they have to do it. Like they have to. Mm-hmm. Our economy is kind of in a negative territory. It's been really bad. The average GDP per capita has been super low for the past almost 2 years now. So we haven't been productive. We're not growing as an economy, and things are looking bad, right? Inflation's still happening. And compared to the rest of the world, some other parts of the world, like Europe, is already dropping the rates already. So I feel like we're going to have to. But the problem is U.S. hasn't.
And then what we do as Canada, we got to just watch the U.S. because if we do something that's different from them.
Well, I mean, yes, because they are our biggest trade partners.
Yeah.
And if our dollar's too low because our interest rates aren't high enough, like their interest rates are high, people are going to invest in their currency. So their currency is going to go higher. Our currency is going to go lower. And that's inflationary by nature because people are going to buy our stuff, through exports, imports, and all that. And, the U.S. is just going to buy all our products and it's just going to push everything up again. Mm-hmm. Inflation. So it's kind of dangerous.
Right. I do want to talk about some of the articles and stats that came out for the month of April, if you're good with that.
Sure.
You have Treb stats open up right now, right?
I do. So if we're looking at sales last month in April 2023, we're actually down by 5%. But the average price at which everyone wants to know is pretty much flat. I think that's going to be the case for the rest of the year unless they majorly drop interest rates. But we're looking at 7,500 sales roughly, with 11,500 new listings. And the new listings part is what scares me. There's 47.2% more new listings last month compared to the previous year. So year over year increases.
What does that mean exactly? How does that really affect us in the future, next month, this month, onwards?
Well, I mean, the biggest trend I like to look at is the sales to new listings ratio, which basically shows you how many, so if you have 2 new listings this month, and during that same month you have 1 sale, then you had a perfectly balanced market, right? Because that means there's 1 more unit available for sale next month if the pace of sales keeps going that way, right?
Right.
So that's the issue. But right now, if you have 3 new listings and 1 sale, then that's a problem. And that's actually what's happening now. So if you look at this number here, the sales to new listings ratio is roughly around 47% for if you look at all housing types, right?
Okay.
And that actually is kind of a little bit more into buyer's market territory. So if you're looking out there for a good deal, maybe now's the time to do it because there's a lot of new listings and you kind of have your pick in properties.
Now, that's the funny thing that I am seeing in these articles. So you're saying that it should be a buyer's market, which because of supply and demand, that is true. Mm-hmm. But when I look at it, and then they still say that the sales price is, as you said, basically the same, but a little bit higher than the last month, just a very tad. Is it a buyer's market? It looks like it hasn't moved.
Yeah, things are flat, right, in terms of average price, but there's a lot of things going on behind the scenes. So the sales to new listings ratio, which is a number I like to really look at a lot, the last time it was this low was back in 2009, after the global financial crisis. And if you guys were old enough to remember that market back then, it was a short blip. It was only 6 months or so, I found, but it was pretty rough. The months of inventory went up the highest peak of eight months of inventory. Months of inventory, basically, they look at the amount of inventory left over at the end of the month, divide that by the number of sales.
Right.
So in theory, if the number of sales were happening, which is 7,500 for the thing, versus the new active listings, which is just a bit over 10,000,
right.
In theory, it would take you a little bit over a month to sell it all. If next month there were 7,500 sales as well too.
Wow.
Okay. But back then in
Like playing catch up a little bit.
well, kind of. I mean, like it's a theoretical construct, which it doesn't actually exist that way. But if you look at it compared, like, you know, month over month over month, you'll see a trend of what's going on, right? So right now I'm loading it up. Back in 2009, actually this is a little bit older. I got to look older than that. But 2009, the months of inventory was somewhere around 8. Yeah, it's not even on this graph right now. But right now we're trending around 2.6 months of inventory. And the last time this peaked this high was 2019. But before that was in 2013 as well, too, which also was kind of a weird time as well.
So, I mean, for the people who are scared, honestly, it's almost like if you can hang on, don't be scared, just because you can make, like, history, I mean, keeps following itself, right? It'll eventually get back to normal.
You would hope.
Yeah.
You would hope. Like it's all interest rate dependent. So there's a lot of talk about what the neutral rate is in the Bank of Canada's overnight lending rate. They're talking about, you know, their whole mandate is basically to get the inflation down to 2% again, because for whatever reason, 2% is a good number for them. And with a, you know, tolerance of plus or minus 1, so anywhere from 1 to 3% they're okay with. So if it goes under 1% or drastically under 1%, then they're going to start cutting rates to spur economic activity. But if it goes well over 2 or 3%, which it has gone to, like at one point our inflation rate was up to 8%, if you remember that, right?
Yeah.
So in order to do that, they have to raise interest rates. More people will be spending more money on debt servicing, and that would really curb spending so that the economy doesn't go rapid fire like this and prices don't increase. Because when the economy goes rapid fire, what do? Right? You have only so much supply, you end up raising prices because inevitably you can get more money, so why not? Right? So that's the whole main point of it. And right now we're at the point where I think it's time to cut, right? Now we have a rate announcement in June, we have one in July, and we have one in September. And there's a lot of talk about this because I don't think we can wait that long, because a lot of parts of the economy is failing. Right, you look at the number of insolvencies has gone up quite a bit, corporate insolvencies. And yeah, just our debt servicing carrying costs for the Canadian government in general is already huge. It's like 20-something%.
Yeah.
So they got to bring down interest rates soon, hopefully. Yeah, anyway, back to sales and new listings ratio. We're looking at 43.8% overall in the GTA. And the last time it was this low was somewhere around 92 in the 90s. And actually, it was a little blip in 2009 during the global financial crisis. But if I get rid of the home type and I just remove it straight to condo apartments in the GTA, the last time it was this low at 40%. And it's even worse in the downtown. If you look at CO1, the CO1 and CO8 districts, it's actually down to 30% sales to new listings ratio. People are dumping their investment condos, right?
Yeah.
But if you look at just the entire GTA of all condos, I'm talking about like Scarborough, you know, Milton, or not Milton, actually it's not GTA, but even like Mississauga and Durham and all that, we're looking at 39%. And the last time it was this low was it back in 93 or like 89 to 93 around there. Ooh. And it dipped down way before that. And you know, like I wasn't around that time. I was around, but I wasn't paying attention to the market. I don't even think it was born yet.
We don't even have that many listings at that time. There wasn't
that many condos
buildings there.
Actually, you know, you're right. There actually wasn't that many. Condos weren't that popular back then. Yeah. But anyway, overall, the market looks like that. It was a rough time for a lot of people as we were rebuilding. That's why we had 2 decades of low interest rates, right, to spur that economic activity, because we had a huge crash back then.
So the government failed us. Well, they made it so then everybody can. At the time in the 90s, all to the early 2000s, we're fortunate enough, then, yeah, they're in the markets. And then now it's kind of like they made a system where the people who are born in or is finally entering the market now is screwed.
They're screwed, yeah. Well, I mean, we were hooked on, yes, you're right. The government did mess us up because we were hooked on low interest rates for a very long time, for 2 decades. And at some point, the real interest rate was actually negative, meaning that the inflation rate versus what you can get the cost of capital at was much lower than the inflation rate. So if you bought anything, you basically have free money. That spread is essentially free money, right? Because the asset will appreciate, but yet you're borrowing at a much lower rate, right? But that's not the case now. It's now real positive interest rates, meaning that the cost of capital and the inflation rate is actually lower. So you have to be smart to actually make money off that.
Oh, wow.
Right? So back then, that's why for the past 2 decades, if you bought anything, you'd be okay. And now that's kind of like just turned on its head right now. And I don't know if it'll ever go back to the time when you know, you buy any asset and it just appreciate.
Right.
right? It's like a perpetual machine almost like. So yeah, I don't know what the future holds, but I just know that they can't keep rates like this forever. So back at talking about the neutral rate. So the neutral rate in the Bank of Canada overnight lending terms, it basically means it's low enough where it doesn't spur unnecessary over excess supply or excess, I guess, economic activity.
Yeah, so just
But it's
trying
not
to tame it.
right, but it's not high enough where it would basically choke people like how we're being choked right now. So
Yeah.
it's kind of somewhere in between. And apparently that neutral rate just keeps going up. Like it's a moving target. It's not like there's no exact science. No one really knows what a perfectly balanced economy is. Right? It's a big problem, a big challenge that's why we have economists, really, right? And a central bank.
So one other stat that I'm looking at your Market Watch screen right now is specifically employment, just because there's been a lot of things coming out in regard to that. I just wanted to know how employment or the employment rates actually influence aspects of real estate.
Yeah,
and
okay, well,
purchasing.
that's a good question. So Toronto employment growth grew by 1.1%, and the unemployment rate is also up, which is kind of weird, right? Like, how did
Yeah.
employment grow, but yet unemployment is high at 7.5%?
What? Yeah. How?
So
what
people
does that mean?
have less jobs, but yet there's more jobs created. Like, it doesn't make sense, right?
Yeah.
What the factor is that you don't see in here is the population growth, right? So as we're growing as a population, there's going to be less people that, there's going to be more people that actually have jobs because they're coming here and getting jobs. But the amount of people actually having jobs or people being laid off is actually more than the population growth. So that's why unemployment is going up. But there's different categories. There's a little more nuances than that. But for the most part, that's, as an overview, that's what you can look at. So if people don't have jobs, it's because the economy is doing bad, right? When the economy is doing bad, if you think about it in your own company, in the company that you work for, if the company isn't making profit because interest rates are too high and cost of capital, cost of your input goods are too high, then they have to basically lay people off in order to be solvent, right? And not be negative for too long. Which means if you don't have a job, then how are you going to buy any real estate? Right? So that's how they kind of go hand in hand together. Or even pay your rent, for example, right? That's a big issue. So the government, the central bank knows this, and they're watching this pretty, like, not only inflation, like the biggest mandate is inflation, but with that is also the unemployment rate. They have to make sure that, people aren't losing their jobs, like too many people aren't losing their jobs before they start doing anything, right? Or actually they have to make sure that people are losing the jobs before they realize, okay, inflation's under control and yeah, we're good to go. But if too many people are losing jobs, then they're going to start doing something about it to spur economic activity, right? With that inflation and jobs hand in hand.
So moving forward from that point, there's one thing that I'm seeing here is that, so as of May 10th, they said, this is an article that says, April asking rent prices up 9.3% across Canada, except Ontario sees its only decline.
Right.
So you were just talking about that, how Toronto, let's say a big thing for Toronto, it's a big business sector, big commerce place, right? So if these companies are laying people off, and does that mean all these people that are coming in here really, because they don't have a job, they have to move elsewhere to a different province, say Alberta?
Well, I think they only moved to Alberta, for example, and they're a huge boom. But the only reason why they move is because of affordability, not so much jobs, right? I mean, there's jobs out there, but it's pretty much, it used to be sectored in around the oil and gas sector, but not so much now. It's a little more diversified. But either way, the cost of living is way cheaper.
Because why is our rent the only one that's declining then?
Because people are leaving. Interprovincial migration, right?
Oh.
It's getting really expensive here.
Right. Okay. So it's, not just jobs, but it's just in general, life expenses.
Life is too expensive here.
Yeah.
Right? So if you're getting a downtown Toronto apartment for, I don't know, let's call it $2,600 is the average rent. And you can get a whole house for that in smaller parts. Well, maybe not Alberta, but other parts I don't know, PEI or Halifax or something like that. Why wouldn't you move out there?
Right.
If that's what you need. If you have a growing family and right?
I will say though, because and this might just be me big braining it, but just working in the fields and seeing a lot of these honestly distressed investors that need to lease their place out in order to just recoup something. They're not even going to be profitable. They're still losing money, but to recoup something. And they're competing against all these other people. So we just saw the chart with all the condos that's on the biggest dip, or Everybody's just trying to sell them off, right? So I feel like there's a connection there almost where everybody's kind of just competing against every other investor, so then they got to drop the prices of their
100%. So all these new condos that got built into, from pre-construction days back in 2017, 2018, 2019 even, they're coming for completion now. They take on average anywhere from 4 to 7 years to build a condo, right?
Yeah.
So I bought one with a business partner not too long ago, and we just closed on it. And just so you know, the cost of capital, the mortgage, got a 3-year fix at a 4.99, which is great. But that mortgage rate alone is already $4,000 a month. Right,
wow.
You add on maintenance fees at $600, plus taxes another $200. We're at $4,800 a month. Meanwhile, the rent that we can get on it is $3,500, and all at the same time. The reason why we chose to do this all at the same time is that there was new listings coming on the market every single day because our whole stack just came onto the market at the same time.
Yeah,
right. They start occupying slowly, and you'll see now there's another comparable of that just got leased for $3,150 without parking. But there's another one for like $3,400, $3,300. There's 2 of them, 34 and 33. So we lucked out and we got $3,500. But before all this new supply came on the market, and this is just only one building. There's other buildings in the area that also are completing around the same time. Right. So as a renter, you have a ton of choice for where you're going to go. And if you see all these units on the market, it's just a race to the bottom.
I see.
The way we're looking at it as an investor is like, okay, well, it's better to get something now and not have another month of vacancy where we're coughing up $4,000, potentially more, $4,800, just to carry the place, to leave it vacant. So I'm just going to get something now and we'll make up the difference eventually.
Right.
That makes sense.
Yeah, that makes sense.
So that's why prices are kind of going in a race to the bottom. And a lot of investors can't hold out for this, right? If you're losing $1,000 a month, $800 a month, whatever it is, right? Sometimes even more. Like have another property is losing $2,000 a month.
Yeah.
Right? So then it's like, it just doesn't make sense to hold anymore because, okay, like the landscape isn't looking better. Average prices are just kind of staying flat. Right?
We know nothing about when these rates are changing.
Yeah, exactly. And even if they change, will it really go up higher? I mean, the rates that are changing are only for the variable rates at the end of the day, right? Fixed rates are still, they're controlled by the 5-year bond, 10-year bond rate, 5-year bond rate for the most part, right? So if you can get a 3-year fix for 4.99 or like a 5-year fix for 5.29 or whatever it is, like in the 5s, like if you look at an overnight lending rate right now, we're at, for the bank prime anyway, it's 7.2% as prime. So usually you get a discount of if you have a good borrower, if you're going from a traditional bank. So you're prime minus half, maybe prime minus 0.4. So you're still in the 6s, in the high 6s, even 7% for a rate. So if they drop it by a quarter point, even 1 point, like 1%, you're still in the like high 6s, almost like high 5s or low 6 rate. Whereas you can get a fixed rate right now, 3-year fixed for 4.99 or somewhere hovering around 5. So it really doesn't affect the market much, to be honest, right? So if you're an investor and you're thinking, shoot, the prospects of these rates coming down aren't that great, I don't see my place appreciating that much, especially as more properties are coming online and immigration is slowing down, then maybe it's just time to dump it. Yeah. Instead of renting it out again, waiting for the tenant to leave or selling it with the place that's tenanted, it just doesn't make sense, right? So that's why I think this spring, a lot of people were waiting to sell it since the winter time. Right, and they just put it on the market now because it's springtime, hoping it's for better times.
Do it while it's active.
Right.
I see.
So I would say right now is a great, strong buyer's market. I mean, depending on what you're looking for. In the low-rise inventory, like houses and all that, some of them are still kind of really good because they're not building any more houses. There's no options for people. But again, it comes down to affordability. How many people can afford, $2, $3, $4, $5 million houses? And now there's this new luxury tax over $3 million. So I think it's a big challenge. If you're a buyer out there, I think it's time to buy something. It kind of makes sense if you're looking in the long run. I
feel like especially our first-time home buyers out there who are entering the market, I feel like this is a pretty good time for them.
It can be. It's just the cost of capital is really high.
As long as you have the cash.
Yeah, exactly, right? So, it's a decision, I guess, that you have to make one round one, right? One by one, to see that if you can go now at a higher interest rate or wait till the rates drop and then get in then. But the thing is, when rates drop, prices are going to go crazy again, right? At least that's what the theory is. So no one really knows. There's a lot of the stuff behind the scenes that you have to really analyze. And everybody's investment thesis is different. Everybody's long-term outlook is a little bit different, or how long they need the property for or their investment horizon. So it's an individual thing.
Yeah,
sure.
everyone wants to time the market all the same, but look at it in your own situation and see what makes sense.
Well, I think that's it too, right? You can't time the market. It's
Yeah.
very hard to. If I could time the market,
I'd have every house in Toronto.
You know what I mean? Yeah, exactly. You'd find a way to get it, right? But it's just you can't. Like we can't time the market. There's so many different variables that go into it. So many different factors in the world, and so many different things happening in the news that just like change everything at a moment's notice. Like, nobody expected COVID,
Yeah.
right?
Yeah.
Nobody expected the war in Ukraine, right? Nobody expected this. I mean, maybe it was going on for a long time, but like there's things that just happen out of nowhere.
Yeah.
And the interest rates and all this kind of stuff. Nobody expected that. Nobody called it that it would rise this fast, this high, for this long. So here we are now. What do we do? I guess. Well, a lot of people are dumping their properties. I mean, we have actually quite a few good listings, right? Neil?
Yeah, no, we have some great listings here. And honestly, like one question that we get is, do you only do Riverdale just because that's where our office is
Really?
based
People are
on?
asking that?
Yeah, some people ask that.
Okay.
I mean, when they call in, right? When they
Okay.
call in.
Okay.
But we have listings everywhere. We do have a Riverdale listing, and that's a perfect investment opportunity for a lot of people.
The commercial one?
Yeah, the commercial one, 253 Broadview
That's
Avenue.
actually a really good one. You know, the commercial market's kind of slowed down so much that I feel like people are kind of scared because the cost of financing is expensive, and no one
Yeah.
really knows where the rental rates are going to go, right? So if you have rents down and interest rates are high, it's not a good environment to want to buy something in. For sure, I agree with that. So that being said, if you break down the numbers, you're actually looking at a potential, after you rent out the places separately and all that stuff, there's only one main place, the main floor place that needs to be rented out again. But once you find a commercial tenant down there, and if you're buying it for yourself, say you had a optometry office or whatever you want to do, right? Like a pet store or something, this is a great opportunity to be an owner-occupier.
Yeah.
Right?
Yeah.
But if you didn't and you want it strictly for an investment, I think it turns out to a 6 cap at the rate that we're selling it at. So it's only listed for $2 million. I think it really makes sense. Forget about the cost of financing, but in terms of cap rates, it's a really good one.
There's
6 cap in
another-
Toronto. That's not normal.
Yeah.
Around 4% usually.
So I was going to say there's another similar investment opportunity, where you can live and rent out. 206 Donlands in Danforth.
Yeah. So right now that's a bungalow, but there's a basement renter. There's a tenant.
So it's not commercial.
It's not commercial, and there's a main floor, which the owners are living in, but you could turn that easily into a rental. And if you had extra capital to do some capital improvements, do a laneway suite. It's right on a laneway, and it's a pretty wide house, 27 foot. So you can definitely put a lane suite back there. I think I got it quoted out like a 1,200 square foot lane suite. And then also you can get a second floor story in addition on top of that. So if you're looking for a place to live in, it's actually not a bad idea. So live in the main floor, continue the basement rental, so you have some income coming in while you're building it up. Build the ADU, which stands for accessory dwelling unit, which is the laneway suite. Live in there, and then build the second story when you're done. So then all of a sudden you have everything done for you, you know?
Yeah.
So if you have extra capital, I think that's a really good opportunity out there.
Yeah, that's a really good one.
And what do you need for that? Well, the place is listed for 1.25, so it's not that much money compared to for regular houses. Everyone's looking for that $1 million house. But say you bought it for $1.5 million, and then to build a laneway suite, you're looking maybe at $300,000 or so $1.5 million. And of course, some of that you can finance as well too, obviously, right? So let's say $1.5 million. You'd have a beautiful duplex. You'd have a brand new laneway suite, and then you can do the topper, which might cost $200,000 to $300,000 on top of that. So all in, you're looking at 1.8 with 4 streams of income.
Yeah,
right.
And to
3
have
stories.
all of that in such a convenient, safe, and wonderful area. I mean, I'm biased because I lived there before.
It's like 5 minutes from the subway station, right?
5
So I
minute
think it
walk
makes sense
to the
from
subway
Danforth.
station.
Yeah, and a lot of stuff on Danforth. So
Yeah,
if I had money, I'd probably buy that right now.
and there's so many good opportunities that we have. We have a property in St. Andrew Winfields where which is a very luxurious area, but you can build your own dream home.
Yeah, you could build it's a 60 by 150, 160 solid,
Yeah.
something like that. It's a pretty huge lot. So, and over there, it's on the old City of Toronto bylaws. So there's no density restrictions, like not the 60% coverage that you see in most places in Toronto. So that means based on the square footage, you're only allowed to build 60% of that as your total gross floor area. But here, you can go as much as you want. So that's why you see these monster mansions over there in that area. And it doesn't have to be a monster mansion to live in, like a custom build, because as you know, the cost of construction is so high. We're looking at like $500-$600 a square foot for a luxury product. It's a lot of money. It's just to build. But if you're ever able to do something like reasonably cost savings, $200-$300 a square foot, not 200, but like call it $300 a square foot, you could build a really sizable multiplex there.
Yeah, I was gonna say. I mean, like I was looking at the average prices over there anyway, and I'm like, it's still a lot better to just build.
Yeah, for sure, for sure. So the lot itself is 1.8 million, but you're surrounded by $5-6 million houses.
Yeah,
You know, so you can't tell me you're going to spend more than $2 million for a 9,000 square foot, 6,000 square foot house, just to say, right?
see, yeah.
So I think it kind of makes sense to do that as well too.
How are assignments doing in downtown Toronto?
So depending on the project, depending on the seller, depending on the capability, some people are just letting go of assignments because the cost of carrying doesn't make sense to be that, you know, negative cash flow, $1,000 a month or whatever it is, right? So they just rather just sell it. There's not much profit anyway, so you're not going to get huge taxes, but they're not going to sell it at a loss.
Yeah.
You know, I find the assignment buyers out there are looking for blood, but like I caution you, if you're an assignment buyer, don't just look for the best deal out there. Yes, of course you want a good deal, but like you could be buying a unit, like a studio unit that's a weird layout that's facing a wall. And just because it's a good deal and somebody's losing their shirt on it, it still doesn't make it a good deal.
Yeah.
Right? Like you can buy resale for cheaper than some of these assignments right now, even though people are taking a loss. So I'd caution you not to just look at the amount of loss that the assignor is taking. I would look at the layout itself, the view, the you know, just where the size of it, everything, all that, and relate it to resale, right? Because resale right now is actually cheaper than the cost of new construction, meaning that the replacement cost for buying resale is actually for buying a new construction, meaning that if you had to build it from scratch again, which, you know, new construction is right now, you can actually buy resale cheaper than that. So in my opinion, resale is actually the way to go. But if you want that brand new, not rent controlled, brand new building, sexy building, assignments are the way to go too. And right now we have 2 available in Nobu. I think that are really good. 2 bedrooms.
No boo.
Yeah.
That's it. That's all you have to say.
Yeah. Like it is. There is a little bit of hype there for sure. But no, mic drop. No. But I think it's a great building, and the ones we have are 2 bedrooms. So there's 2, one with a view and one without, and they're priced accordingly, I think.
And sorry, I don't want to make this podcast too long, but I do want to send a message to like everybody coming into Toronto or people who can't really afford to buy a home yet, but still need somewhere to be. I mean, we have rental units as well. We have our own property management group too as well. So then we're fortunate enough to have a number of these listings out here.
Oh my God, we have a lot.
Yeah. So I mean, we have a lot, so I don't want to say all of them. But whichever area you want to go to, whether it's West Side Toronto, East Side, North, we have some listings for you.
There's 11 listings that we have right now. We have anything from basement apartments to even room shares to a luxury. Do we have any luxury ones right now?
Well, we have some
houses.
We have some pretty nice
2 bedrooms
condos out here. We have some luxury condos out here. We have one at One Bloor.
And that's a nice luxury one.
Yeah.
Yes.
Yeah, One Bloor.
That view is amazing. If you haven't seen that view, oh my God.
Nothing is going to obstruct you because it's the biggest building here. So
yeah. Well, actually, no. Right across is One Bloor East.
Oh,
One Bloor
okay.
West.
That
but
one's the biggest one.
Even still, just to it's only a sliver of the sky.
Yeah.
When you look further south, you see the CN Towers, which is gorgeous, and to the north is completely clear. You're overlooking the Hudson's Bay or the what's that hotel? W Hotel. So you overlook that, but you're right at the best intersection in the city, which is Yonge and Bloor. You can't go wrong with that.
Yeah. So we have units like that. We have nice big homes such as 68 Burnett. We even have nice family areas like 87 Trinell. Oh, it's leased now?
That's not available.
See, as I'm talking, it just goes so quick.
The rental market is going to be heated for a little while, especially as affordability is just kind of out of control.
Yeah.
So I think there is a lot of options as a landlord if you decide to buy something for the long run. Again, remember, you can't time the market, so don't even bother doing that. But if you had to look at the stats of the sales and new listings ratio and the history of it, reach out to me if you want to see the graph, by the way. But the sales and new listings ratio over the history, we haven't found a better time to buy according to that graph since the 80s, like late 80s to early 90s. So,
all right, and I think that concludes our segment today, everybody.
All right, thanks for watching, and I guess we'll catch you in the next one.
See ya.
Add it up. Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.